Hello, everyone. Welcome to the stock specific class here for Thursday, August the 18th. If you have any questions during the week or any questions I don't get to here in the live class, make sure you send those to Jerry at traderspro.com. Make sure you don't send them to support because they'll just forward them on to me. So make sure you send them to Jerry, Jerry, at traderspro.com. And if you forget that email address, this is in the recording. If you want access to the recorded classes, you can go to the YouTube channel, subscribe to the Traders Pro page, and you'll have access to not only these updates, recordings, but there's a lot of other training videos I've done in the past. Now, in those training videos, it's important to point out that I usually did the training on the topics. I usually did the training part after doing the market update or during the stock specific class, and so you'll have to fast forward to usually I do the update for about a half hour, and then I do the training the second half hour. So if you fast forward to about that halfway point, you'll be able to get to where I start to get into the trainings. So you can see the different topics on that page as well. So if you want to learn more about trend analysis or candlesticks or trade management techniques, entry techniques, trailing stop techniques, things like that. I've covered just about every topic I could think of in those videos. So there's a lot of content there that you can go through. All right, let's get started with first taking a look at the market condition. And today's update is probably going to be a little bit boring because the market is just kind of stalled out a little bit. It's the volume is very light today. I am going to show you so we can learn how to recognize it, that there is some buying exhaustion that's going on. That doesn't always mean that the market's going to drop, but it is something to pay attention to, and really because of it puts us in a position where you don't want to be trading in this type of market condition. When you're seeing buying exhaustion, you don't want to be buying because it could be signaling. Especially in an overbought market, which we're in, it could be signaling that we're getting ready for a correction. But you don't want to short or bet to the downside that the market's going to drop when there's buying exhaustion, because it could shake it off and still go higher. You'd want some confirmation that it's rolling over first. So then it puts you in a situation where you don't want to be doing anything. This is not a high probability trading environment. So I could just wrap up the update today and everything, because even the specific stocks I'm going to go over today, I wouldn't recommend that you're jumping into them in these market conditions. But instead of just wrapping up the update 5 minutes into it, I'm going to teach you how to recognize the buying exhaustion and some of the different possibilities and what's kind of going on, so we can recognize when we might move towards a more tradable market and where we can become a little bit more active. There's an old Wall Street saying that says you never want to short a dull market, and that's kind of today is a dull market, so you don't want to short it, you don't want to buy it, and it's one of those things where you just want to sit on your hands. And that's difficult. Some people can't do that. They have money in their account, they want to get it working, they want to get it going, but that's something you have to learn, that discipline to be patient and wait for the opportunities that are going to give you the best chance for success. All right, so let's go through the direction alerts. You can recognize the direction alerts are showing kind of a tired market. What's the signal of a tired market? Well, if you go down to this chart right here, this is showing you all the three indicators that we look at here in the direction alerts. It's showing you sentiment, breadth, and momentum. The blue line is sentiment, the green line is breadth, and the red line is momentum. And there's a reason why I don't talk about this chart very often, because really it's only significant when when you're at these extremes. And when you have, and you might have to go back and review this in the recording, or if you're taking notes right here, whenever you have, see the blue line is at the top right here. So first of all, we're overextended. We've rallied, the market's rallied up. We're in kind of that overbought condition. This is kind of overbought, this is oversold down here. Whenever you have sentiment, so the blue line right here, above breadth, which is the green line right here, and both of those are above momentum, it's signaling a tired market. So your momentum, you see, is lagging. Your breadth is still pretty good. Sentiment is really high. So the market is really getting too bullish. It's getting too confident, too complacent. Momentum down here is lagging. It's telling you that there's some buying exhaustion or the market's tired. Okay. So again, maybe an easier way to remember it is just in order down here. If the blue line is above the green line, and the green line is, and blue and green line are above the red line, that's signaling a tired market. Now the opposite would be true when you're at a market bottom and you're seeing you could be in a position where the market could start to rally off of that or move higher from that. You'll have sentiment, which will be at the lowest point, and then breadth, the green line, will be above sentiment, and then momentum will be above both of those. And that's signaling the opposite. Usually that'll happen down here, and you'd want to be down here at these lows when that happens. Now, again, it's not a perfect indicator. It's definitely not something you're going to base your entire trade on. So don't get crazy with something like that. And because sometimes what happens is you're so anxious to apply something you just learned that the minute you see it again, you're like, oh, I just saw it. That means the market's going to go down, and you don't wait for any confirmation. You don't wait for anything else to confirm confirm the move, and you go and jump in, and then you get burned. It could be one of those times where you get burned, or it keeps moving higher. It doesn't mean the tired market can't continue to go higher. We're recognizing that it's tired. It's like a marathon runner. You can see a marathon runner is running out of steam, but they could still run another 2 or 3 miles before they collapse or something. But you can see that they're in trouble. You can see that they're they might be wobbling a little bit when they're running. So what we're doing right now is we're recognizing that the market is wobbling a little bit. Could it keep going for another mile or two? Possibly. But we want to be aware of that, because then if we see that runner collapse, we know, okay, that's when the market's going to drop, and that's when we want to act. We get that confirmation. Okay. All right. So now momentum again did back off a little bit. It was starting to get close to that extreme. We're looking at this on Tuesday. It's backed off a little bit, but you could make the argument that again that what we saw in that upper chart, the momentum is lagging a little bit. It's not moving stronger than breadth, for instance. And breadth, you can see, is kind of in the middle of that extreme range. Could get more extreme, and then obviously sentiment is at the far right, and it's been that way for a little bit. We've recognized that, and that's a good point. We've recognized that sentiment's been in this extreme range, but yet the market has still been grinding a little bit higher. So what we're doing right now is getting a sense of the market mood. Now, if we go to the buy-sell ratios, we have come down a little bit from that extreme level we were at on Tuesday. Market pulled back a little bit yesterday. We'll take a look at that chart here in a second. But we're still pretty wide. We're still pretty extreme there. I also showed you the sentiment indicator is pulled back a little bit from that extreme, but it's still elevated, still pretty high. We also looked at the indexes, the index tab up here, and noticed that again all these buy-sell ratios a lot of them were in double digits, which is an overbought condition. So what are some other clues of recognizing a buying exhaustion? Well, take a look at the SPY right here. Back here on Thursday, last Thursday, and by the way, remember last Thursday I was very bearish on the market, and on that bearish reversal we had. Almost every time you're going to get a pullback out of it. We didn't get it, but again, one of the things I talked about on Tuesday though was that possibly that was just an early warning sign, signaling a potential weaker rally. Now, what's the characteristic of this candlestick situation? Whenever you have the market gap up, anytime you see the market gap up and then go close lower than where it opened, that is a bearish reversal. It is a bearish. It's a weak price action. It's telling you that the buyers are not strong enough. They weren't strong enough to hold the gap up the day to build on that, to close it higher. And anytime you see that type of behavior, that's bearish. Okay, now there are different degrees of how bearish. And one of the strongest bearish reversals is when you gap up, you close lower than where you opened, but you are still higher than the day before. So that day we closed lower than where we opened, but we were still up from where we closed the day before. And the reason why, again, it's such a strong reversal is because if you don't know what you're looking for, it's hidden from everyone else. Everyone else is going to be looking at, hey, did you close higher than you did the day before? I mean, think about it. What's the first thing you go look at on CNBC? You go look in the lower right-hand corner to see how much the Dow is up or the S&P is up, or is it down for the day? All of that data is comparing the performance today of the day before. But it doesn't tell you the whole story. And if you don't know how to look for the other clues of momentum shifting, then you can get burned. And so the reason why this one works so well is because everyone's looking at, hey, we're up from yesterday. So why is everyone thinking the market's going to drop? Market's not going to drop. It's higher from yesterday still. But they're not recognizing that momentum shift of opening very strong and not being able to hold that, to be able to reverse that. And like I said, like 95% of the time, you're going to get some sort of a pullback off of that price action. It may not necessarily start a downtrend. It could, but it usually you're going to get some sort of a pullback off of that. Okay. Now, now that type of price action also depends on where it's taking place. For a bearish reversal, you'd like to see it take place after a run-up. The market's been running up, the stock's been running up, and then you get that bearish reversal. And it doesn't have to run up a lot, but you'd like to see a few days at least of the more time it's been rallying, the stronger the reversal signal is. So if you've had a 2-day rally and then you get this bearish reversal candle, maybe not as strong. You might it may mean you still open lower the next day, but maybe it goes right back up again. Usually, though, if you've been going up, and then you get that bearish reversal, it could lead to a bigger pullback or bigger drop off of that if it's been going on for a while. If you get this type of price action, though, near a bottom, to where so here's an example right here. So we were going down. We gapped up. We closed lower than where we opened, but still higher than the day before. That actually, in the context there where it's been dropping, is actually a sign of selling exhaustion. It's actually a little bit more of a bullish reversal signal, although not a real strong one. So it's not one I like to trade because a lot of times it needs some confirmation, or it can come early. This would be a stronger bullish reversal, which is just the opposite. When you've been declining right here, if it gaps down and then closes higher than the open, but still lower than the day before, where it closed the day before, that's a very strong bullish reversal. It usually means it's going to go up. And again, a huge percentage of the time, it's going to go up the next day. Again, it doesn't necessarily mean it's going to start an uptrend, but because remember, these candles are very short-term indicators. They're not going to tell you, by themselves, are usually not going to tell you how far it could go off of that. So, but the opposite then would be true if you get and that's what happened yesterday. We've been going up. We opened lower. We closed higher than where we opened, but still lower than the day before. This would be a sign of buying exhaustion. So we opened lower, and the buyers got excited, and they started to buy the dip, so to speak. It got all the way up into here, but then it faded. It came all the way back down. They weren't able to hold that rally, and they ended up closing. Actually, here's where we closed the day before. So we ended up closing well below where we closed the day before right here. That's showing buying exhaustion. Okay. Now, like I said, that alone, much like the selling exhaustion that I was talking about earlier, right in here, much like the selling exhaustion isn't necessarily going to lead to a rally. It's not a strong reversal. The buying exhaustion is not necessarily a strong reversal. Okay, I don't want to be shorting just because I'm seeing buying exhaustion, because we see this happen sometimes where you get a pause and then it could take off again, or it pauses. So this could be a warning of a pullback ahead. This buying exhaustion could be a warning of a pullback ahead. It may surge forward for a few days, looking like it's shaking it all off, and then bam, it can lead to that really sharp sell-off. Because what I've been talking about for the last couple of weeks is I feel like this rally, there's going to be people chasing the rally. It's going to suck people in. It's good. The market has to, in order to have a big sell-off that's a panic sell-off, the market has to get to a point where it thinks it's past. It's not going to have the downturn. The bear market's over, and the bad stuff is all in the past. It's safe to get in now. And more, and on top of that, not only is it safe to get in, but you better get in or you're going to miss it. That fear of missing out, and we're seeing it all over the place. Boy, if you just watch one of the panel shows on CNBC, you've got almost everyone. It seems. Well, there's a few that I consider usually the smarter people in the group, but or more credible people in the group. But there's so many that are saying, "Oh, it's done. We're done. We're going higher," and we're seeing it. The market is acting that way. We're seeing huge volumes of call options being bought in the options market, and that's a sign of usually a market top, when people are so confident to go buy those calls that they think that they're with the volume and amounts that are taking place here, that it usually is a sign that they're too confident, that they're too bullish. And then you throw on top of that an overbought market condition that we just viewed, and we're at a spot right here where it could get ugly pretty fast. But again, not to short yet, because I'm not getting any sort of strong reversal signal. Now, that I thought last Thursday, I thought that was a pretty strong reversal signal, and it shook it off. So it also tells you that that's what makes a marketplace, is that sometimes you get the lower probability move. We got the 5% move instead of the 95% move. But I think that even shifts that bullish sentiment even stronger, because the people are saying, hey, we didn't reverse right there. We just shook it off and went higher. I think if the same thing happens here, if they're recognizing a tired market and then it has another surge higher, maybe just a day or two or three, I think that could be what sets up for a bigger decline. Now, we're also at a key resistance area. I talked about this area on Tuesday. We traded above it on Tuesday. We closed right at it. And then look what happened yesterday. We opened below it. We traded all the way up to it, that 429 area, 429, 430. It's kind of in that area. I don't look for exactness, even though a lot of times it goes right exactly to the price or very close to it, and then came off of it. Today, we tried to trade up close to it. We're a real compact trading day today. It's like this thing has not moved at all. And by the way, again, that's another warning sign that you don't want to be shorting that, because really when you get these really big swings back and forth, that tends to be more bearish. Volatility usually equals more bearishness. Now, there's different degrees of bearishness, right? You see prices swinging back and forth pretty wildly. It could mean that maybe you're going to drop a little bit in the next few hours or so, or something like that, or maybe just it could be you drop for a day or two or something like that when you're seeing that increased volatility. But typically, and again, you don't want to base your trade decision on this alone, but typically when things are swinging back and forth in a big way, that's usually more bearish. And you'll notice that a lot of times in these rallies, when the market is rallying, one of the reasons why I was turning more bullish in this area right in here was that we were getting just steady moves higher, not huge moves higher, but we were just kind of getting steady moves higher. We'd pause a little bit. We weren't getting these really big swing back and forth. I mean, look down here in the decline. You had right in here. Look, you had these wild fluctuations back and forth, big up days, big down days. And that's usually a sign of it's usually a bearish sign when that happens. And that could, like I said, if we could throw out the overbought signals we're seeing and the bullish sentiment getting a little bit too high, this has been acting like a pretty good uptrend. It's climbed kind of a wall of worry. That we hear that term a lot. Where it has news that worries it a little bit, but it doesn't freak it out, and it kind of keeps going higher. So we'll keep an eye out for that. We'll see if anything changes in the next few days. But again, if you want to look for a better condition to buy, if we can clear that 429, 430 area, you could look at that as a sign to turn a little bit more bullish at a time. Just make sure you don't ignore. We're still in kind of that extreme condition, a tired market condition. You wouldn't want to be getting too aggressive there and buying too much. Another thing I thought was interesting is, and I think it's a bellwether that we could keep an eye on. It's been being talked about a lot the last couple of days. Is the behavior of Apple. And we're going to add it to our market update here just to, because I think it's been interesting. And this is another reason to be a little bit worried about the rally, because especially the big institutional traders, when they are confident that the market's going higher, that a bottom is in, they will get into the riskier, they will spread out. They'll get into a lot of different trades, a lot of different sectors, and a lot of the smaller cap type trades where they have the chance to get the bigger return and feel safe that they're going to get that bigger return. When they're a little bit worried or concerned, or they don't quite trust the conditions, they tend to pile into just the stocks that they think are the safest. And Apple is like right now at a very extreme level, the safest trade to make right now. If you look at how it's behaved, it's pretty much recovered all of the losses over the last year. It's almost breaking out to a new all-time high. If you look at the run-up over the last few weeks, there has not been more than one down day. Here was a little down day, and then it's basically a flat day. It opened lower here and went up. This was a little bit of a down day. It went up. After that, a little bit of a down day here. It went up. Here you had the rare 3 down days in a row. but even then, they were real compact. And then it was fear of missing out. And so you've got big institutional traders getting into this. You've got retail traders that's all they know is to go buy Apple. Apple is I've got a love-hate relationship with Apple because when I first started coaching so many years ago, well, it wasn't when I first started coaching because Apple was actually not even on the radar when I first started coaching. But I know when Apple really started to take off, and a few years into when it really started to take off. So this would be back in probably 2008, 2009, something like that, where, the iPhone had come out and everything, and all these products were out there. And I used to hear from a lot of people. I out and traveling and stuff, I'd be talking to people, and they'd find out what I do, and people would comment that, oh, I'm a really good investor. I own Apple, and I've been in Apple, and that of course makes me a great trader, a great investor. And it used to frustrate me because it's like, when you happen to be in a stock that's high growth and everyone's piling into it and it just seems to never go down, that doesn't mean you know what you're doing. It means you're smart enough to stay in it and go along for the ride, but that doesn't make you a great investor or a great trader because you're riding that momentum. But anyway, so you've got everyone piling into this. And so this is going to be, if we want to see a signal of a bigger pullback happening, we want to pay attention to Apple, because Apple is probably going to be what triggers it, or at least gives us a clue that the sell-off could be bigger. If after all of this, we see Apple with a big down day on very high volume, that is going to be a big warning sign. And that would be a warning sign to go to cash, even not want to be in anything really at that point. And I don't know when. Obviously, I don't see. I am seeing a little bit of buying exhaustion. We came off the highs of the day on yesterday. We have a little bit of an inside day here, and you can see where we opened lower, and we're trying to push higher, but we can't. And this will be important to watch. Can we even get above yesterday's close? If not, that's a little bit of a signal there of possible buying exhaustion. Now, I saw a chart yesterday that I thought was also interesting, and something to pay attention to as well. If we go out to a one-year chart, you can see it, where if you connect these tops right here, and I'm not going to be able to draw the best straight line here, but because that's not the straight line. The point is, it actually lines up perfectly with where we closed. If I could draw the straight line, almost perfectly where we closed yesterday off the highs. It tried to break out of that trend line, and now we're back below it. We're back in this range below it. You also have, if you connect the lows down here, you have this big expanding, what we call an expanding triangle, or kind of like a megaphone type chart pattern. I wish I could draw a straight line with this. And so this could be an area that holds, and so if we got a big, strong reversal, doesn't look like it's going to happen today, but if we got one tomorrow or Monday or something, right in this area right here, I think that could be significant, and something to pay attention to. Obviously, you'd want to look at the VIX as well, see what the VIX is telling you, if there's a lot of fear in the selling. But I think this is going to have to break down. You're going to have to see Apple have a big drop if you're going to expect, because can you not see how that would create panic? I mean, you think of everyone that's in Apple right now thinking that's a safe trade, and that's where they're going to be okay. They're fine. They're in their shelter, right? And suddenly the roof blows off of that thing. You're going to see panic. You're going to see everyone trying to get out, but it might take a day or two to really create that momentum, because you think the first day, if it pulls back, especially if it's not a big pullback, that's buy the dip. Oh, great. Apple gave me another chance to buy some more. And so that's why, or what if it breaks out of that trend line, but it gaps up and then it closes lower than where it opens, but still higher than the day before? Boy, if you get that price formation, again, remember, it doesn't always work, but it's like 95% of the time you're going to get some sort of drop off of that. That would probably be a pretty strong bearish signal there as well. So keep an eye on that. I just thought that was interesting. I don't draw the longer term charts on every stock I'm looking at unless I'm trading it. I'll take a look at the bigger picture sometimes to see if there's some things I can see. But I thought that was interesting that it was sitting there right at that trend line. So, and again, it's been going up a little bit too fast. All right, let's peek into some of these others here. The Dow. Usually, we'll look more in the Qs and the small caps. Same thing here. We're seeing again a little bit of that buying exhaustion. We'll see if that leads to anything. Russell 2000 had a pretty decent down day yesterday. And I think what's significant here is this was that bearish reversal candle last Thursday, and we almost got down to it yesterday. Well, again, we'll keep an eye on those. Bonds still kind of moving sideways. You remember last Thursday, it looked like we were having a pretty strong impulsive move that maybe we're going to head lower off of that. Since then we've kind of just been kind of moving flat. If we can find a little bit of support in this area here, you do have the potential of an inverse head and shoulders pattern developing, and typically your right and left shoulders are going to end at about the same spot, which we're basically in about the same spot. This would be your neckline right here. And that's why I told you on Tuesday, if we break back up above there, that'd be very bullish for bonds if it could get back above there and break clearly above that level there. Because, if it gets significantly below this area here, it's probably more likely to test this low and maybe even go lower. What you're looking for, ultimately what you're looking for is to make sure it's a higher low than back in here. At some point, it could still drop, but you want it to be higher than back in here, and then break to higher highs, start acting like an uptrend. And right now, not real clear. Although if you look at, you can see kind of, if you look at a longer term chart, you can kind of see where it's, you did break this trend line right through here, where you're not, this is clearly moving down. This is looking more like it's starting to bottom out a little bit. Now what you're looking for again is, do you get that higher low, higher highs, start to move up the right side of the bowl, so to speak. It's always something you look for on charts. That'd be very bullish behavior if it could start to do that. And gold is kind of forming a similar, kind of a little bit of a similar pattern there, where it might be, maybe not quite as much. You had a little bit of a pause right here. That's still pretty angled right there. I don't know if that'd be a true head and shoulders pattern, but I must have been looking at, because I was flipping through these before class, and I think there was a delay. I think I was looking at, because I thought this was the gold chart, and that's what jumped out at me immediately, was that inverse head and shoulders pattern. I must have still been on the TLT, because it's right after, gold's right after it. Because that's not, because I was thinking in my mind, oh yeah, gold was forming an inverse head and shoulders pattern, but it was the TLT that was, and gold is, it's not a real great reversal. There is a little bit of a bowl-shaped move here. I mean, if you can hold a higher low right there, that'd be a little bit more of a bullish sign. Go to a higher high. It looks like we've kind of broken that trend line a little bit. And obviously you have a fundamental reason to believe gold could go up with inflation being high. It's usually a hedge against inflation, although it really hasn't been acting like much of a hedge against inflation lately. Oil's again the back and forth. I think I talked about this kind of descending triangle formation. Usually, if it breaks the downside, that would be more bearish. If it breaks to the upside, it could be more bullish. And we're right at it. We're right at that trend line today. We did move up today. Although usually the stronger trade in a descending trend line is when it breaks support, because it's come down these levels and bounced off of it each time. And if it breaks that, it's usually a stronger move down. If it breaks the triangle, the angled part of the triangle there, it's usually not you could get a little bit of a run off of it, but it's usually not the strongest break of the pattern. All right. The dollar continues to move higher. I talked about this on Tuesday, that again, this looks like it was the correction right here. Now with today's move, we've gone to a little bit of a higher high right there. This is looking more impulsive. A little bit of a pause right here, but looking more impulsive. So it's looking like it. And with today's big move, it's just acting like it wants to go higher. So we're assuming that the dollar is going to continue that uptrend. The VIX is really low, and again, you say, well, isn't that supposed to be bullish when it's really low? Well, again, it's when it gets down to these lower levels that you start getting these spikes, and where you get these market sell-offs. Now it's kind of flattening out, and this isn't a true representation of the VIX, as I mentioned many times. It's the ETF we use to kind of look at the VIX using Traders Pro, but you've got another chart if you've got another charting service where you can pull up the VIX, you'll notice it looks a little bit different than the VIXY. But same concept here, though, is we're in a tired market. We're seeing just very low readings, very low volatility. There's just nothing happening. If we get a sell-off or a bearish reversal candle and we get a big spike, especially if it closes near the highs today, we've seen a couple of these spikes where they faded a little bit. We saw that yesterday where the VIX spiked a little bit but faded a little bit into the close. But they can hold it. That's a warning sign. That's something you'd want to look for. Would tell you that those big fund managers are starting to buy protected puts. I think I showed this on Tuesday as well. The chip stocks have been underperforming. They have not been able to break out above that June high, where the other indexes have, and chips should be leading the way. Now you could make an argument here that maybe that's a higher low, pretty bullish candle today. Could it be about to break out? But my argument against that would be, well, yeah, but it's supposed to be leading. So if it's still lagging, even if it breaks out here, it's probably warning that the rally is not as strong as everyone thinks it is. These chip stocks should be this thing should be way up here. It should be higher than the breakout of the indexes if it's a really strong rally. So want to pay attention to that. Now, on the flip side, I talked about this on Tuesday, that transports have been showing that leading move, that they're well above the June highs, although they kind of flattened out right here. It's kind of showing what we're seeing, the rest of the things we're seeing here. It's a little bit of a tired market. So a little bit of a conflicting signal there. Bitcoin, well, that declined yesterday. You're hoping it kind of keeps this bowl-shaped move, and if it gets down closer to this low, even if it starts to take out that low, that'd be a lot more bearish. It'll start to look a lot more bearish, and maybe more likely it's going to continue to move down. That'd be another signal of warning. And then I introduced this on Tuesday, the high yield corporate bond chart. This was that bearish reversal on last Thursday. It had a bearish engulfing pattern. Friday, Monday, Tuesday, it was not able to get outside of the range of that candle. Yesterday it broke below that range. Today it's still flat, but it is diverging. It is not even above that Thursday high, even though the market has gone above that Thursday high. So pay attention to that. Could it be that that's putting in a lower high right there, and this could be leading the way down? It could be a warning that at least a pullback could be happening. And again, I think that's important to point out that I'm not suggesting that, although the conditions are getting in a situation where we could get a real sharp sell-off that maybe retest those June lows, it could just be that we just have a normal ABC pattern and then take off again, just a normal correction. Kind of like what happened right here. You had a little bit of this wasn't really overbought right here, but you had this little correction that took place and then it took off again. Could that same thing kind of play out again? Yeah. All right. Just for some ideas, we'll go to, again, the muscle stocks. We've been looking at kind of the new buys. I want to show you a couple things. First of all, if you're using this, you got to remember that we still want to focus on just the high strength rank stocks. So you really don't want to go below 90. I'll take a peek at the 88s or something like that to see if there's a really strong pattern there. 88's not too far from 90, and I'm still willing to jump in on something like that. But you want to kind of make sure you don't get too far down the list here. And then you're looking for, again, patterns, good bullish patterns and price action to go along with it. And so we start at the top right here, IRTC. I just want to kind of go through this and show you things that I would be looking for. This one actually looks pretty deep. The price action today is bearish, but overall, you got kind of this little V-shaped move that sometimes you'll see this type of correction will kind of make a V-shaped move and break out. You have a previous high right here. You're not too far away from that. And it's also possible that this is kind of wave A, wave B, wave C. But this is one you've got to keep an eye on. I do like the fact that it broke to a higher high right here and looks like possibly having a higher low right there. JAKK. All right, so this one is one you'd stay away from. Okay, so you say, well, it's on the new buy list. It has high strength rank. Why would I stay away from it? Well, again, gets back to the fundamental trend analysis. Stocks will tend to alternate between impulsive and corrective moves. When you're in an uptrend, the impulsive moves will be up. When you're in a downtrend, the impulsive moves will be down. So you'll get an impulsive move up, and then your corrective moves will be more choppy, more sideways. Corrective, impulsive, corrective, impulsive, corrective. When you reverse trend, not always, but one of the characteristics that you can look for in a trend reversal is very often you get back-to-back impulsive moves in the opposite direction. So if I'm reversing from a downtrend or uptrend into a downtrend, you might get impulsive up followed by impulsive down. And especially if it went down to a lower low or something like that. Now, that alone doesn't mean that it's a reversing trend, but again, because you know the behavior, then what should happen after that impulsive move down is you should get corrective. It should be more choppy, more sideways, and then that should be followed by impulsive down, corrective, impulsive down. When you get to a bottom, you'll see me do this a lot when I see a stock that's pulled back, and I'm like, I like this pattern. Usually what's happened is it's because you've had impulsive down, impulsive up, and then you get corrective, and that means the next move should be impulsive up. So what jumped out at me when I'm looking at this chart is I see impulsive up, impulsive down, and then on this rally right here, it's been more choppy, more corrective, more sideways. So now there's plenty of times where a stock can come down, impulsive down, look a little bit choppy, and then take off again. I'm not saying that this is not going to be how every chart behaves or how it behaves every single time. But again, these are characteristics. It's like if I'm a a police officer. Well, what are characteristics of a burglar or something? Well, they tend to do this, they tend to do this, they tend to do this. Well, does that mean that every single person that commits a burglary is going to act the same way? No, but there are collective traits that certain people will do over and over, that you can recognize that behavior, and or at least have it help you in case of a police officer, and help you solving a crime or something like that. In this case, it'll help us be able to recognize the more probable move that should take place. Now, it could be that this is just impulsive down, corrective, and this is just wave A, wave B, and you're going to get an impulsive move down for wave C, maybe fill in that gap right there, and then it takes off again. That could be what happens. All I know is that, again, the first thing that jumped out at me on the chart was, I want to stay away from this right now because there's too strong of a chance this thing's going to have another move down, and I don't want to be buying it right when it has that move down. And so I wanted to focus on this chart because we don't know what's going to happen next. We can see, you can put this JAKK in your watch list and see what it does over the next few weeks, and see if it doesn't have that move down. I bet there's a pretty high chance it will. And if it does, you could say, okay, that's valuable to know. I got to learn that. I got to learn that behavior because I can use that. It may not be getting me into a trade. It could be just something telling me not to get into a trade. And that's sometimes as valuable as knowing when to get into a trade. And just my luck, this thing's probably going to go through the roof. And everyone's going to go, Jerry, you don't know what the hell you're talking about. Again, the probable move is it should have another move down. All right. So right in here, you've got, this is one where you're still kind of in that decline, lower highs possibly, but you're getting a little bit of this bowl-shaped move right here. You have a pretty sharp move up right here, and this could be a little bit of a correction where it's moving a little bit sideways. See if this moves a little bit more sideways here. I'd like to see that in a trend reversal. That's a pretty bullish sign when you have kind of this cup-shaped move. It looks like you're on the right side of the cup, and you start getting these little pullbacks right here. They often are real subtle signals that maybe you're going to rally back up again. Still need probably a little bit of confirmation, and that could be just going to a higher high. What if it goes to a higher high right here, and this is a higher low? That's acting like an uptrend if it can do that. All right, let's go through a couple of sectors here. Like I said, I went through all these, and there's none of these really are ones that I just would love. I'm gonna point that out right in the beginning here. But this is a stock-specific class, so I want to have something to go over. If we look at the transportation stocks now, again, why are we focused a little bit on these upper ones? Well, these are your sector rankings right here. And this means that right now, oil is the leading sector that's outperforming all the other sectors out there, transportation, utilities. And so theoretically, what you're trying to do with the software here is you're trying to stay as much as possible in the stronger sectors and the strongest stocks within those sectors. And so that's why what you'll see now, the reason why you say, well, wouldn't those be the buys within those sectors? Yeah, and you could look at that. And you'll see me do that. I'll go into the buys, see if any of them are pulling back. They might still have a buy signal, but they might be in a pullback, or I might be able to recognize that corrective behavior within the uptrend. But the reason why I usually go to the holds as part of the systematic approach is that it can be kind of that final confirming factor. If I see a stock I like in the energy sector that has a nice bullish pattern, then I'm just waiting for it to go from hold to buy, and I can put it on a watch list. I can have it send me an email when it goes from hold to buy, and I can get into that stock when it goes back to a buy signal. So it provides a little bit of a systematic approach there where you can just go through this every day and build your watch list. And we will do more of that when we're out of a bear market. But like I said, we've been in a unique situation for the year. When things are declining, you want to be mostly in cash, and you want to be very selective in what you're getting into. And when the market starts to get more in a bull market again and a bullish trend, we're going to be, this is exactly what we're going to be doing. We're going to go into the highest sectors and the best stocks within those sectors, going from hold to buy. And it's a real cool approach where you can just kind of do it. It's real easy. If you want easy, it's a good way to kind of build a routine, a daily routine around. Okay. All right. Let's go to transportation stocks under the holds. Right at the top of the list, 98 strength rank, STNG, Scorpio Tankers. You know, it recently broke out, came back, retested the breakout. It's in a clear uptrend. The only thing that I'd be a little bit worried about here, and this is just something real subtle that you can add to your analysis, and maybe you got to be careful too with technical analysis. You got to determine what your most important things are that you're looking for. Because what happens when you study technical analysis is there's a lot of things you can study. And so if you've got a list of 50 things that you're looking for, and you want all 50 to tell you the stock is going to go up, this is a mistake I made when I first started trading. And I'm like many of you, you get excited, and you're like a sponge. You want to learn everything you can. And so you learn about MACD indicators and RSI, and Fibonacci analysis and ABC patterns and stair-step analysis and Bollinger Bands, and you start, and all of these things are real cool when you learn, because like, man, I can see where these can work here or there, you know. And so what you do is you think, okay, I know what if I could just find the stock that has all 50 of those things telling me it's going to go up, then I'm guaranteed to make money. And the problem is that no, you're not guaranteed to make money. It still comes down to trade management, money management. Nothing can tell you exactly what the stock is going to do. And so now I encourage everyone to get as much knowledge as you can, because there are times where I will look at certain things, or I'll notice certain things that I don't look at all the time, but because I've learned them in the past, it stands out. I will pull up an RSI sometimes, although most of the time I can already tell when a stock is overbought just on the chart. But I will pull these things up from time to time just to see, I wonder what this looks like right now, and I'll pull it up and look at it. And I know how to read it, so I have that knowledge. But you don't want to get into that paralysis of analysis where you're trying to apply so many things. And again, what causes that? What causes that is the belief that the more things you apply is going to make it more likely to work out. And no, it's not. So what you want to do is get it, and this is what I finally came to the conclusion was, okay, I got to find out what's the most important thing, and then I can add other things along the way. Well, what it came down to is the basic kind of kindergarten approach of the stair step. Know the stair step. Know impulsive corrective moves, and know how to recognize impulsive up, impulsive down, corrective. That can be a trend reversal. Know about ABC patterns. Very often in those steps or those sideways moves, you'll get usually it's a 3-step move. You get an initial sell-off, a bounce, and then another sell-off, and then that completes it. The wave C is usually about the same length as wave A. That's a good thing to know. That can help you kind of get an idea of how far that C leg might go down. Another thing that is valuable, I don't always consciously apply this, it's usually subconsciously now, is that stocks will tend to retrace about 50% of their moves. So if it moves up about $4, it's probably going to pull back about $2 and go up about $4 and pull back about $2. It will tend to retrace about 50% of its move. And again, that's what kind of creates that stair step, that higher high, higher low. Now, it doesn't always retrace exactly 50%. There's a range there, anywhere from about 1/3 to 3/4 is kind of a range, but a deep retracement, if it gets down way down here, it still might be at a higher low, but a deep retracement can also be a signal that the stock could be reversing it. Maybe this isn't a pullback within the uptrend, but this is actually in a trend reversal. It's probably more likely to drop to a lower low right there. So getting back to this chart, nice move up. This was not a 50% retracement, maybe about a third. It retraced about a third of the move, went higher. This is a big retracement. That's a pretty deep retracement. So it didn't go much higher when it went to a higher high, and it's coming almost all the way down to the low. I don't know if I trust this one as much. This is one that I'd probably say it's still an uptrend, but it would have to break out for me to get in, because I'd have to be confident this deep retracement wasn't actually a reversal. And if it could go to a higher high, it would at least be a higher low right there, and then it would go to a higher high on the breakout, and I'd have a lot more confidence in it if it could break out from that. So that's what jumped out at me when I was looking at this one. But again, it's an uptrend, and you could make the argument that this is maybe this is wave A, wave B, wave C, and this is all just kind of sideways, and it's going to break out higher. But there again, it should hold in this range, and it should break out above here. And so why not wait for the breakout just to be sure? But that could be an indication of momentum. Again, we're looking for momentum clues. Impulsive, pulls back 50% of the move. Impulsive, pulls back 50% of the move. Impulsive, oops, that's more than 50. That's more than 3/4. The 618, it's actually 61.8%. If it drops below 61.8%, it's a Fibonacci level. So it's not quite 3/4. It's actually less than 3/4. But you know, I see that right there. It's like, that could be. I don't like that. That's too much of a pullback. That's too deep. So that's important to know, because that's, like I said, that a lot of times I'm doing it subconsciously. So I'll pull up a chart on, if I'm going through these sectors, I pull up a chart and I'm like, I don't like that. I have to sometimes stop myself and explain why I don't like it, because to me, it just doesn't look right. It's just part of my subconscious now. Why does it look like? Oh, because it had that deep retracement right here. I can't trust that. And so I got to kind of force myself to do that sometimes, because I know there's a lot of you that are new and still learning this, and I have to try to remember what it's like to not know what I know. What jumps out at me just looks like probably gibberish to a lot of you, or it looks like you can't. Just looks like a bunch of these bars. Oh, another thing that you got to learn is candlestick analysis. You got to learn how to read price action. And I do that a lot in these classes, but I'll teach you that. But there's at least some of the real strong ones. That's something that's very important to apply. All right, we got to wrap things up. Business services. This RCMT at the very top. I think there was something I was going to, this was something I was going to show you here. So what jumped out at me was, okay, this is a pullback off the highs right here. And then what you had? You had corrective, then you had impulsive down, impulsive up. And then it's kind of looking like it's moving a little bit corrective here. If it can kind of go a few more days where it looks a little bit more sideways right here, that's an inverse head and shoulders pattern. Especially if it can break out above here, that thing could be on its way. It may not, but again, that jumped out. Impulsive down, impulsive up. That's typically what happens at a bottom. Back-to-back impulsive moves in the opposite direction. Again, none of these I'm saying jump into right now, but that's something that you can pay attention to. That's kind of a teaching moment there. That's what I'm looking for. And then let's see, business services. I have the NOV right here, 92 strength rank. And there again, you had Impulsive down, corrective. Impulsive down, impulsive up, corrective. It looks like it's turning the corner here. You could wait for it to break out to be sure. That would give you a higher high. And to go with your higher low, that one's interesting. That's NOV. All right, let's wrap things up. Take real quick again, like I like to do, is take a look at see if the S&P has changed much. We're trading slightly higher than where we opened, but it's still sluggish. I think the volumes were very light today. Yeah, look at that. Very light volume. And this candlestick formation, if it holds, is what we call spinning top. It's an indecision candle, and which means it could go either way. It's not giving us a clear prediction of where the market could go, and that's the basics of everything I talked about today. Is that we could go either way right here, and we're in a little bit of a tired market, but we could still go either way right here. So that's my conclusion. So I did manage to fill up an hour, but I didn't think I'd have enough to talk about this week, or this class, but hopefully you learned something. And we'll see you next week for the market update on Tuesday. Bye, everyone.